The journey to $1 million is paved with misconceptions. It is a goal shrouded in the mystique of lottery wins, inheritances, or high-flying ventures that seem utterly disconnected from the reality of ordinary life. The title of this analysis, How to Make Your First Million, starting with $0, appears on the surface to be another entry in this genre of fantasy. It is not. This is an examination of a system, a repeatable, logical process grounded not in luck, but in the fundamental laws of economics and human potential. The promise of starting with $0 is the most misunderstood part of the equation, and it is here that our analysis must begin. To watch until the end is to understand not a secret, but a blueprint, one that has been executed in various forms for generations. The first and most critical truth is this: no one truly starts from zero. While you may have zero financial capital, no money in the bank, no assets to your name, you are not empty-handed. You possess three forms of non-financial capital that are infinitely more valuable at the outset. First is human capital. This is the sum of your knowledge, your skills, and your capacity to learn. It is the most powerful income-generating tool in existence. In a world that increasingly values specialized expertise, your mind is the first asset you must cultivate and monetize. Second is social capital. This is the network of relationships you have. It is not about knowing wealthy people. It is about trust, reputation, and the ability to collaborate. Economic activity is, at its core, a series of human interactions. A strong network provides opportunities, information, and support that cannot be purchased. And third is the capital of time. For the young, it is your single greatest and most frequently squandered asset. Time is the catalyst that allows for compounding, the engine that drives all significant wealth creation. The path from zero financial capital to $1 million is not a single leap. It is a sequence of converting these non-financial assets into financial ones. The first phase is the generation of a surplus. Your primary objective is to convert your human capital into an income stream that exceeds your basic cost of living. This is not about simply getting a job. It is about the strategic acquisition of high-value skills, skills that the market is willing to pay a premium for. This could be anything from software development to specialized sales, from digital marketing to skilled trades. The focus must be on maximizing your earnings per hour. During this phase, every spare moment of your time capital should be reinvested into your human capital, learning, practicing, and mastering your chosen skill. This creates a feedback loop. The more you learn, the more you can earn. The more you earn, the more resources you have to learn further. Once this income stream is established and a surplus is generated, meaning you are spending less than you earn, you enter the second phase. This is the most crucial pivot in the entire journey and where most people fail. It is the transition from an earner to an owner. You must take your surplus capital, no matter how small, and put it to work. This means investing. It is essential to distinguish saving from investing. Saving is accumulation for the purpose of preservation. It is passive and safe, but it will not make you wealthy. Its value is eroded by inflation. Investing is the deployment of capital into assets with the expectation of generating a positive return. It involves risk, but it is the only path to substantial growth. The mathematical force behind this growth is compounding. Often called the eighth wonder of the world, compounding is the process where your investment returns begin to generate their own returns. A dollar earned by your dollar then starts earning its own pennies. Over time, this creates an exponential curve. It is a slow, almost imperceptible process at first, but as the years pass, the growth becomes explosive. So where does one invest this initial, hard-won capital? There are fundamentally two proven paths. The first path is ownership in the broad market. For the vast majority of people, this means consistently buying low-cost index funds. An index fund is not a single stock. It is a basket that holds small pieces of hundreds, or even thousands, of the largest companies. By buying an index fund, you are not betting on a single corporate horse. You are betting on the entire race, on the aggregate growth and innovation of the economy itself. Historically, broad market indexes have returned a long-term average of 8 to 10% per year. By methodically investing a portion of your income, month after month, year after year, the power of compounding on these returns will, mathematically, build a seven-figure portfolio over a period of decades. This is the slow, steady, and most reliable route. The second path is direct ownership in a business. This path carries higher risk, but also the potential for a much faster timeline. This is where you convert your human capital not just into a high income, but into a scalable system. A doctor has high human capital, but their income is limited by the number of hours they can work. An entrepreneur who builds a medical software company, however, has created a scalable asset. They can sell their product to thousands of doctors simultaneously. Building a business is about creating a system that generates revenue independent of your own time. This asset, the business itself, can then become worth $1 million or more. Finally, we must address the concept of leverage. Leverage is the use of borrowed resources to amplify potential outcomes. In the market path, this is generally discouraged for beginners. But in the business or real estate path, it can be a powerful accelerator. Using a bank loan to purchase a cash-flowing rental property is a form of leverage. Hiring employees in your business is a form of leverage. You are leveraging their time to expand your output. But leverage is a double-edged sword. It amplifies gains, but it also amplifies losses. It should only be approached from a position of deep knowledge and calculated risk. Let us be clear. This process is not easy. It is simple, but it is not easy. It requires immense discipline, a relentless focus on increasing your value, and an unwavering commitment to a long-term plan. The first $1 million is rarely about the money itself. It is a byproduct. It is the result of building a system within your life. A system for learning, a system for earning, a system for investing, and a system for managing risk. You do not start with zero. You start with the raw materials of your own potential. The journey to $1 million is the lifelong process of refining those materials into assets of measurable worth. The question is not whether it is possible. The question is whether you are willing to execute the blueprint.